Tulip mania. In the early 1600s, the Dutch Republic was one of the wealthiest nations in Europe, and among its most prized possessions were tulip bulbs. These exotic flowers, imported from the Ottoman Empire, became a symbol of luxury and status. But what started as admiration quickly turned into one of history's most infamous financial bubbles. By the 1630s, demand for tulips had skyrocketed. Rare varieties like the Semper Augustus were selling for more than the price of a house. Speculators, ordinary merchants, farmers, even sailors began trading tulip bulbs, believing prices would keep rising forever. Banks and investors fueled the frenzy, offering credit and loans so people could buy more bulbs. It was the 17th century version of get-rich-quick investing. But in February 1637, the market collapsed almost overnight. Buyers vanished, leaving sellers stuck with tulip bulbs that were now worthless. Fortunes were lost, businesses failed, and while the Dutch economy survived, the event became a cautionary tale of how speculation and greed can lead to economic ruin. This wasn't just a flower craze, it was the first recorded financial bubble in history, and it wouldn't be the last. South Sea Bubble. Imagine an investment so promising that even the King of England was involved, only for it to end in one of history's most devastating financial crashes. This was the South Sea Bubble of 1720, a scandal that wiped out thousands of investors and shook the British economy to its core. The South Sea Company, founded in 1711, promised to make investors rich by monopolizing trade with Spanish colonies in South America. The company's directors convinced the public that unimaginable wealth was just around the corner. With government backing, people rushed to buy shares, driving the stock price up by over 800% in just months. Even members of parliament, prominent bankers, and King George I himself invested in what seemed like a surefire fortune. But there was one problem. The company had no real business. The promised trade deals with Spain never materialized, and profits were pure fiction. When investors realized the truth, panic set in. By September 1720, the stock price collapsed, ruining thousands, from aristocrats to common merchants. Suicides rose, public outrage exploded, and many company officials were arrested for fraud. The South Sea Bubble was more than just a financial disaster. It shattered trust in the British financial system and forced the government to create stricter regulations. Yet despite the lessons learned, history would see similar bubbles time and time again. Panic of 1837. In 1837, the U.S. economy seemed unstoppable. Banks were lending freely, businesses were booming, and land prices were skyrocketing. But beneath this prosperity lay a ticking time bomb of bad policies, reckless speculation, and a banking system built on shaky ground. When the crash finally came, it plunged America into one of its worst economic crises, lasting nearly a decade. The roots of the crisis can be traced back to President Andrew Jackson's economic policies. He had dismantled the Second Bank of the United States, the country's central bank, and issued the Specie Circular, requiring land purchases to be made in gold or silver instead of paper money. This move drained banks of hard currency, leading to financial instability. Meanwhile, banks had been giving out risky loans, and businesses had overextended themselves in an overheated economy. Then, in May 1837, everything collapsed. New York banks suspended all payments in gold and silver, effectively making paper money worthless. Bank failures spread like wildfire, businesses shut down, and unemployment soared. Within months, thousands of Americans lost their jobs, farms, and life savings. The crisis hit hardest in the West and South, where farmers and land speculators had borrowed heavily, expecting never-ending growth. The aftermath was brutal. The U.S. remained in economic turmoil for nearly 7 years, known as the Hard Times. The government struggled to fix the crisis, and only in the mid-1840s did recovery finally begin. The Panic of 1837 was a harsh lesson in how bad policies, reckless banking, and speculation can bring even a booming economy to its knees. But it certainly wasn't the last time America would face such a disaster. The Long Depression. Imagine an economic downturn so severe that it lasted over 2 decades, crippling industries, wiping out banks, and leaving millions unemployed. This was the Long Depression, 1873 to 1896, a global financial crisis that reshaped economies and exposed the dangers of unregulated markets and overexpansion. The collapse began in 1873 when a major Viennese bank failed, triggering panic across Europe. But the real devastation hit the United States, where rapid industrialization and railroad expansion had created an economic bubble. Railroad companies had borrowed huge sums of money, betting on endless growth. However, when banks began pulling back on loans, the railroad boom collapsed, taking Wall Street down with it. On September 18, 1873, J. Cook and Company, one of America's largest investment banks, went bankrupt. The New York Stock Exchange shut down for 10 days, marking the beginning of the crisis. Over the next several years, over 18,000 businesses failed, and unemployment soared to 14%. Workers suffered greatly. Wages were slashed, strikes erupted, and violent labor conflicts became common. The crisis wasn't just limited to the U.S. Europe, Canada, and Latin America all experienced economic slowdowns. The shift from bimetallism to the gold standard only worsened the problem, tightening money supply and making recovery even harder. While some historians debate whether the Long Depression was one continuous crisis or a series of recessions, one thing is clear: it fundamentally changed global economies. Governments became more cautious about unregulated expansion, labor unions grew stronger, and the financial system faced calls for reform. By the 1890s, economies began to recover, but the scars of the Long Depression were felt for years. It was a stark reminder that unchecked speculation, bad banking policies, and reckless expansion can trigger long-lasting economic disasters. Wall Street crash of 1929 and the Great Depression. On October 29, 1929, known as Black Tuesday, the unthinkable happened. Wall Street crashed, wiping out billions of dollars in a single day. But this wasn't just a bad day for stocks. It was the beginning of the worst economic crisis in modern history, plunging the world into the Great Depression for an entire decade. The 1920s had been a time of excess, with stock prices skyrocketing thanks to a booming economy, mass production, and easy credit. Everyone, from big investors to factory workers, was pouring money into the stock market, often using borrowed cash. The belief? Stocks would keep rising forever. But by mid-1929, cracks began to appear. Overproduction left businesses with unsold goods. Wages weren't keeping up with inflation, and banks were handing out risky loans. When investors realized stocks were overvalued, panic set in. Between October 24th and October 29th, 1929, the market lost nearly $30 billion, an amount greater than the U.S. government's annual budget at the time. The effects were catastrophic. Thousands of banks failed, wiping out people's life savings. Businesses shut down, leading to mass unemployment, nearly 25% in the U.S. Global trade collapsed as countries imposed tariffs and hoarded resources. Breadlines and shantytowns, known as Hoovervilles, became common sights. The Great Depression didn't just affect the U.S. It spread worldwide, devastating Europe, Latin America, and Asia. Governments scrambled for solutions, but it wasn't until the New Deal policies in the U.S. and the start of World War II that economies finally recovered. The Wall Street crash of 1929 was a harsh reminder that unchecked speculation, easy credit, and economic inequality can bring even the strongest economies to their knees. But as history would later show, financial collapses weren't going away anytime soon. Great Chinese Famine economic collapse. Most economic collapses lead to unemployment, financial ruin, and recessions. But the Great Chinese Famine, 1959 to 1961, was far worse. It led to the death of an estimated 30 to 45 million people. making it the deadliest famine in human history. At its core was a catastrophic mix of failed policies, economic mismanagement, and political stubbornness that brought China to the brink of collapse. The disaster began with Mao Zedong's Great Leap Forward, an ambitious plan to transform China from an agrarian society into an industrial superpower. The government forced farmers into collectivized communes, banned private farming, and pushed for massive steel production, often at the expense of food production. Farmers were ordered to use unscientific agricultural techniques, such as planting crops closer together and deep plowing, which led to devastating crop failures. To make matters worse, local officials, fearing punishment, falsified grain production numbers, making it seem as though China had more food than it actually did. As a result, the government exported grain to other countries and continued to take food from starving villages to meet quotas. Meanwhile, natural disasters like droughts and floods worsened the crisis. The economic consequences were devastating. Agricultural output plummeted, leading to widespread starvation. Industries collapsed as the focus on backyard steel production proved useless. Food shortages led to mass death, with people resorting to eating tree bark, dirt, and even human flesh to survive. China's economy shrank, forcing the government to reverse policies by 1962. The Great Chinese Famine wasn't just a natural disaster, it was an economic and political failure. It exposed the dangers of government overreach, poor planning, and ignoring economic realities. Though China eventually recovered, the scars of this period remain a reminder of how economic mismanagement can lead to unthinkable human suffering. Oil crisis and stagflation. For most of modern history, economies followed a simple rule. When growth slowed, inflation dropped. But in the 1970s, something unprecedented happened. The economy stagnated while inflation soared, creating a crisis known as stagflation. And at the heart of it all? Oil. It all started in October 1973, when the Organization of Petroleum Exporting Countries, OPEC, led by Arab nations, imposed an oil embargo on countries that supported Israel in the Yom Kippur War, including the US and much of Western Europe. Almost overnight, the price of oil quadrupled, sending shockwaves through the global economy. Gasoline shortages led to long lines at gas stations, factories shut down due to high energy costs, and inflation spiraled out of control. At the same time, the US and other Western economies were already struggling due to the end of the gold standard, Nixon's 1971 decision to abandon the Bretton Woods system, which caused currency instability, high government spending from the Vietnam War and social programs, leading to budget deficits, wage price spirals, where businesses raised prices to keep up with rising wages, making inflation worse. By 1979, a second oil crisis hit when the Iranian Revolution disrupted global oil supply, sending prices soaring again. Inflation in the US reached 13.5%, and unemployment remained high. Traditional economic policies failed. Raising interest rates didn't fix inflation, and increasing government spending didn't boost jobs. It wasn't until 1982, when the U.S. Federal Reserve under Paul Volcker took drastic action, raising interest rates to nearly 20%, that inflation was finally tamed. However, this triggered a severe recession, pushing unemployment to over 10% before the economy stabilized. The oil crisis and stagflation era proved that energy dependence, reckless government spending, and poor monetary policies can cripple even the strongest economies. And though the world eventually recovered, the lessons of the 1970s still shape economic policies today. Latin American debt crisis. In the 1970s, Latin America was booming. Countries like Mexico, Brazil, and Argentina were borrowing heavily from international banks to finance massive infrastructure projects, industrial expansion, and social programs. The future looked bright until everything collapsed, plunging the region into a decade of economic chaos, inflation, and mass poverty. The crisis began with a simple but dangerous cycle: easy credit. Global banks, flush with petrodollars from the Middle East, thanks to high oil prices, lent huge sums to Latin American nations, believing they would develop rapidly. Over-borrowing. Governments took out loans at low interest rates, assuming that economic growth would let them pay back their debts easily. The shock. By the early 1980s, everything unraveled. Oil prices fell, interest rates in the U.S. skyrocketed due to the Federal Reserve fighting inflation, and global demand shrank, leaving Latin America drowning in debt. The breaking point came in August 1982, when Mexico declared it could no longer pay its $80 billion debt. Panic spread as Argentina, Brazil, and other nations also faced default. The consequences were devastating. Currency devaluations wiped out savings. Hyperinflation. Argentina's inflation hit over 3,000% in some years. Widespread unemployment and social unrest. Harsh austerity measures imposed by the International Monetary Fund, IMF, in exchange for bailouts, leading to deep recessions and poverty. It took Latin America nearly a decade to recover, with some countries struggling well into the 1990s. The crisis exposed the dangers of reckless borrowing, over-reliance on foreign loans, and mismanaged economic policies. It also reshaped global finance, leading to stricter lending policies and economic reforms across the region. But the scars of the 1980s debt crisis still linger, serving as a warning for nations that grow too fast on borrowed money. Asian financial crisis. In the 1990s, Asia was booming. Countries like Thailand, Indonesia, South Korea, and Malaysia were growing at breakneck speed, attracting billions in foreign investments. Nicknamed the Asian Tigers, these economies seemed unstoppable, until a sudden financial collapse wiped out trillions of dollars and plunged millions into poverty. The crisis began in Thailand in July 1997. For years, Thailand had maintained a fixed exchange rate, keeping its currency, the baht, tied to the US dollar. But as the country borrowed heavily and foreign investors flooded in, a real estate and stock market bubble formed. When investors lost confidence and pulled out their money, Thailand ran out of US dollars to maintain the exchange rate. The Thai government was forced to let the baht crash, setting off a chain reaction across Asia. As panic spread, currencies collapsed. The Thai baht, Indonesian rupiah, and South Korean won lost over half their value. Stock markets plunged, wiping out fortunes overnight. Mass layoffs and bankruptcies. Businesses reliant on foreign loans couldn't repay their debts. Millions lost their jobs. IMF bailouts. The International Monetary Fund, IMF, stepped in with emergency loans, but in return, governments had to adopt harsh austerity measures, cutting spending and raising interest rates, deepening the recession. By 1998, the crisis spread beyond Asia, hitting Russia and even Wall Street, leading to the collapse of the U.S. hedge fund Long-Term Capital Management, LTCM. The crisis only ended when countries stabilized their currencies, restructured debt, and reformed their financial systems. The Asian financial crisis was a harsh lesson on the dangers of overdependence on foreign investment, weak banking regulations, and unsustainable debt. While Asia eventually recovered, the scars of 1997 reshaped global financial policies and remain a cautionary tale for emerging economies. Dot-com bubble burst. In the late 1990s, the internet was the next big thing, and investors poured billions into tech startups, many with no profits or business models. Stock prices for anything internet-related skyrocketed, creating a massive speculative bubble. But when reality hit, billions vanished, and the market crashed. The hype, internet gold rush, easy money. Low interest rates and venture capitalists fueled reckless investments. Irrational optimism. Dot-com companies were valued on potential rather than revenue. Stock market mania. Tech IPOs exploded, with startups like Pets.com surging. Media frenzy. The internet revolution was overhyped, drawing in amateur investors. The crash. When the bubble burst. By 2000, overvalued companies with no real profits collapsed. Investors panicked, and the Nasdaq lost nearly 80% of its value by 2002. The fallout. A tech massacre. $5 trillion in market value vanished. Thousands of startups failed. Even giants like Amazon barely survived. The dot-com bubble was a harsh lesson in speculation and hype. But out of the wreckage, companies like Google and Amazon emerged stronger, shaping the future of tech. European debt crisis. Just as Europe was recovering from the 2008 financial crash, another crisis erupted: the European debt crisis. Greece, Portugal, Spain, and Italy found themselves drowning in debt, teetering on the edge of bankruptcy. The crisis threatened to tear apart the European Union and collapse the euro, forcing emergency bailouts and harsh austerity measures. The root causes. How it all started. Easy money and overspending. The introduction of the euro in 1999 made borrowing cheaper, leading governments to take massive loans without enough economic growth to sustain them. 2008 financial crisis. The global recession reduced tax revenues, making it harder for countries to repay their debts. Weak banks. Many European banks were overloaded with bad loans, worsening the situation. Investor panic. As confidence dropped, investors demanded higher interest rates on government bonds, making debt repayment even harder. The breaking point. Greece's meltdown, 2010. In 2009, Greece admitted its real debt was much higher than reported. Investors panicked, pushing Greece's borrowing costs to unsustainable levels. Greece requested a bailout in 2010, triggering fears of a European financial collapse. The domino effect. Crisis spreads across Europe. Portugal, Ireland, Spain, and Italy also faced severe debt troubles. The IMF and European Central Bank issued bailouts, but with strict austerity conditions like spending cuts, tax hikes, and pension reductions. Protests and riots erupted, especially in Greece, where unemployment soared above 25%. The aftermath. How the EU survived. The ECB launched massive stimulus programs to stabilize markets. Countries restructured debts and implemented spending cuts. By the late 2010s, Europe stabilized, but economic scars, high unemployment and slow growth, remained. The European debt crisis proved how reckless borrowing and weak financial policies can push entire nations to the brink. While the euro survived, economic tensions in Europe still linger today. COVID-19 recession. In 2020, the world faced an economic catastrophe like never before. This wasn't a financial crisis caused by reckless banks or market bubbles. It was triggered by a global pandemic. The COVID-19 recession became the worst economic downturn since the Great Depression, shutting down industries, wiping out jobs, and forcing governments into action. The shock. How it all started. When COVID-19 spread worldwide, governments imposed lockdowns to slow the virus, but this froze economies overnight. Businesses shut down, especially in travel, tourism, and retail. Unemployment skyrocketed. Over 22 million jobs were lost in the U.S. within 2 months. Stock markets crashed. The Dow Jones lost 30% of its value in March 2020. Oil prices collapsed. For the first time ever, oil prices went negative. The response. Governments fight back. To prevent a full-blown depression, governments and central banks took extreme measures. Massive stimulus packages. Trillions were injected into the economy through stimulus checks, business bailouts, and unemployment aid. Interest rates cut to near zero. Central banks printed money and bought assets to stabilize financial markets. Emergency health spending. Billions were spent on vaccines, medical supplies, and pandemic relief. The recovery, a roller coaster rebound. By late 2020, economies started recovering, but challenges remained. Supply chain disruptions led to global shortages. Inflation surged as governments printed money to stimulate growth. Long-term debt concerns raised fears of future economic instability. The legacy. A new economic era? The COVID-19 recession reshaped the global economy, accelerating trends like remote work, e-commerce, and digital finance. While recovery came by 2021 to 2022, inflation, debt, and inequality remain key concerns today. This crisis proved how fragile economies can be when faced with an unpredictable global disaster, and raised a critical question: are we prepared for the next one?